Like many people, you probably want to get your car paid off faster, or possibly you're what they call underwater, meaning you owe more on the car loan than the car is actually worth and you feel stuck. We're going to get into 3 different things. I always have to say my disclaimer, this is informational purposes only. It's not financial advice. I don't know your personal situation, but I want to help you get out of debt. And a lot of people are having a lot of problems with the car. So we're going to talk about 3 different things. 1, you're not alone. I'll show you some quick articles. 2, it's best to know exactly how car loans and the payments break down so you know how to attack them. But most importantly, we'll spend the rest of the time looking at multiple ways and multiple calculators to help you get your car paid off faster and or get out from a loan that's crushing you because you might be stuck, meaning you can't trade it in, because in order to trade it in, you got to give them the car, plus you got to write a check because the car is worth less than what you owe. We'll talk about that last. So let's take a look at this. It says a new car costs nearly $50,000 on average. This is March of 2025. And 1 in 5 people are making payments of $1,000 or more. If you're close to that or you're over that, you're not alone. There's also a spike, and this goes back to 1990 till present day. It's the largest percentage of people, 6.6%, that are 60 plus days delinquent, meaning they've missed, I guess, at least 2 payments. So a lot of people having issues. That's why I want to put this video together. I've done many on how to get out of debt, particularly with respect to cars and other things, but let's take a look at what you can do. On the site, Hack Your Credit Cards, there's links down below in the description. There's financial calculators. They're broken down by types, like credit card you see here, but let's look at car loans. The first, there's 4 here. The first one talks about the true cost calculator. With each of these calculators, when you click this link, it'll open up a new window. This is the auto loan calculator to determine the true cost of the car. Each one has an in-depth video if you want to watch how to use the calculator. I'm going to jump right into it, but I'm going to show you the payments and how they break down. So if we use this $50,000, you put in your price. Loan term, 60 months, we're going to assume. We're going to use this throughout the calculators. Interest rate, 12%. We're going to take out all of the trade-ins and other things. There's a sales tax. All right, when we hit calculate, it says on this particular loan, it would be a total loan amount of $53,500 because there was some sales tax and the car was $50,000, sales tax $3,500. All right, so monthly payment, $1,190. Now let's talk about how these payments break down and how you can pay your car off faster and why. It's because you will always owe this loan amount of $53,500. The additional is $17,905 in interest. So that number we can attack. We can lower the amount of interest, and that's how over time you'll pay less. Here it says total price, you'll pay a total of $71,405. That's the $53,500 plus the interest. If we can lower the interest, we can end up lowering how much you'll pay. Now, as you scroll down, it breaks down. This is the most important part to understand. This is called an amortization schedule. It's showing you each row here is a month. Month 1, month 2, month 3. So this is the month column. You've got interest and principal of $535 interest on month 1, $655 principal, and the total payments is $1,190. See, that's our payment. But notice here, this column of your monthly payment, as you know, stays the same. $1,190 stays the same every month. These 2 things, interest and principal, change. Why? Well, you're starting off with a balance of $53,500. When you calculate interest, it comes out to be $535. That just goes to the bank. It doesn't help you pay the car down. The principal column here, $655, pays down the balance. So you take the total, $53,500. This does it for you, of course. You're subtracting this, what goes to principal, and you're ending up with this balance. All right, why did I explain that? Because if you look here on row number 2, the next month, look what happens. The payment's exactly the same. But instead of $655 going to principal to help pay down your loan, it's more. It's $662. Why does more go to principal on the next month? Because the interest is less. Why is the interest less? Why did it go from $535 to $528? Because the first month you're calculating your interest on $53,500. Some money goes to pay it down. Now the balance is $52,845, which is less than $53,500. So when you calculate interest on this, it'll be less interest. And then that amount to principal, $662, pays down the balance. Now the interest is calculated on that, and the interest becomes lower. So as you can see, each month the interest goes down, 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 which means the amount of principal can go up because you're still paying $1,190 and you're putting more to pay down the loan. Okay, the reason that's important is because this one simple principle that all of these calculators use, if you can drop your balance faster, in other words, pay the principal amount here faster, meaning you pay more, then you're dropping the balance faster. And if you drop the balance faster, as you go down here and you're like, well, look, instead of 52, if it was 45, you'd be paying 724 towards principal instead of 655. Okay, so the whole goal here is pay down, get rid of the interest. So over time, you'll pay less. And you do that by paying down the principal faster in a multitude of ways. Let's get into that. So there's 3 more calculators here. We're going to start with the easiest one. They're going to get a little more complicated, but stay with me, and we'll talk about what to do if you're underwater. So the first calculator here is very simple. It's called the Auto Loan Early Payoff. Again, there's a video that talks about everything. But we're going to I put in the same numbers, $50,000. I think I said it was 12% interest rate. You put in your numbers here. How long is the loan term? So this is what is the total loan term. And then here, how many months are left? We added this because you may have already paid off when you're using this calculator some months. You may have already made some payments. So in this case, we made 12 payments already. So we would put 48 here. All right, so that means there's 48 months left. Now I'm going to start with 0, meaning what is your additional monthly payment? We hit calculate. You'll see here, it describes it. It says you'll shorten your loan by 0 months. Okay, now why are you going to shorten your loan by 0 months? Well, you're starting with month 12 because we already paid off the first 12. And this is your monthly payment, $1,096.78, and it's showing you paying it down, just like the amortization schedule. However, watch what happens if so you've got 48 months left. Watch if you were just able to put another $100 a month. You pay a little more. When you add to your monthly payment, because the interest is already calculated, every additional dollar you add to your payment goes right to principal. Remember, if we pay principal down, we add more. We pay the principal down faster, we pay less interest, and that pays off the loan faster. Okay, so for the last 48, if we were to add another $100, however that may happen, it tells you up here, you'll shorten your loan by 5 months. So instead of 48 months, 48 minus 5, you'd only have 43 months left. That's great. Those last 5 months, you'd have no payments. And you'd save $2,000 in interest. Okay, if we go back to that original calculator, total interest was $17,000. So we'd only be paying, for saving over $2,000, we've got it down to like $15,000, which means instead of paying $71, we're paying $69. Now, if you're making $1,000 a month and you're able to pay an extra $100, maybe you've got some extra income, maybe you've decreased some expenses, but bottom line is you're going to save money. You add that extra $100, you'll save $2,000. What if you paid a little more, $200? You can see where this is going. Hit calculate. 9 months. That's substantial. What is that? 3/4 of a year? So you'd only have 37 more months left. You'd be paying, it shows you here, by adding $200 to your payment, you'd send in $1,296. You'll save $3,000 in interest. Okay, so this is just showing you if you could add a little bit each month, what would happen. Next one. Again, there's a video to tell you exactly how it works, but watch this. $50,000 was our loan. We said it was 12%. Loan term 60 months. Let's say we've got 48 left. We're going to get rid of this right now because you can add multiple. This basically says, okay, instead of adding a little bit every month, what if you were able to make a one-time additional payment? Maybe Christmas came along and your aunt gave you $500, or you got a bonus at work, or you were able to sell something in your house. You had an old bike, an old computer or something, and maybe you're able to make a one-time payment. So you would put it here. So in this case, let's just say we got $5,000 and we're going to make it on month 14. So on month 14, for whatever reason, we were able to add another chunk. Could be a bonus from work. We hit calculate. So it starts with 12 because we said we've already paid 12 months worth. This depends on where you are in your loan. And we said $5,000 on month 14. So notice this, your $1,000 payment, your $1,000 payment. Then all of a sudden, month 14, it went to $6,096 because you send in the 5 plus your payment. And then back down to $1,000 a month. What would that one-time payment do? Look here, 42, 41, and then boom, it dropped to 35 because of that big payment. Great. So what? What does it do? Well, we think we have 48 months left of $1,000. No, it shortens it by 6 months, and you save $2,500 by dropping that in. The way I also look at it, I have a whole video about this, is if you had another $5,000, you might say to yourself, well, we got this bonus, we paid taxes on it, we have $5,000, we should put it in an account, like a checking account, and get 1% interest, or 10% or 5%, whatever you're able to get. And over the couple years, what would we have? Okay, now compare that to this. You put $5,000 into the car, you're saving $2,500 in interest. That's like getting $2,500 on top of your $5,000. That's your return on investment. That's pretty substantial. If you had another one, let's say it wasn't, Christmas came around, so maybe that's month 14, maybe that's 10 months from now. So we'd say like month 24. Let's say that Christmas, you got another $1,000 and you hit calculate. And as you go down here, month 24, there it is, the extra $1,000. It drops it some more. Now you've taken off 8 months and you've saved $2,800. So there you can understand if you're trying to do opportunity cost, when you come into a little more money, this might encourage you to say, you know what, let's look around. Let's dig through the stuff we have. Let's sell some things that we don't need. Let's take that extra cash and put it in here. How much can we put in here? How often can we put it in? What should we do with that bonus? It'll make a huge difference depending upon your loan. It's specific to your terms. The higher the interest rate, the more of a dent it's going to make. Okay, that's a second calculator. Here's an interesting one, and I would encourage you to watch the video because it is quite complicated. Here we go. This one basically says, what if you were able to get another loan, like a short-term loan? And we will get to what to do if you're underwater in 1 second. If you're able to get another loan and you take that money and put it towards your car, would you be better off or worse off? You're going to pay the car down faster, but the new loan has interest. Well, it all depends on the numbers. So what's your loan amount? We're going with $50,000. And once the interest rate, we said 12%. How long is the loan term? We're doing all of these the same, just apples to apples. And 48 months left. Okay. You can add multiple of these, but let's say you were able to get a short-term loan of $5,000. You get it on month 14. It's for 12 months. You see these sometimes offered, let's say it was 8%. Maybe for some reason your bank is offering a short-term loan. Okay. Hit calculate. Now, it explains it in words, and then it shows you. I'll go through both. It says you'll save $2,296 and 6 months. So instead of 48 months left, you only have 42, but you'll save $2,300. Here's why. Your loan normally would have had $15,800 in interest, but with this scenario, you're only going to pay $13,500. And it explains, by making lump sum payments, that's that one lump sum of $5,000, you save an additional $2,296. It was calculated by subtracting the additional payment interest paid from the total savings. You save $2,508 in interest by making the additional payment. So here's what really happened. By making this additional payment on the car loan, you saved $2,500. However, on this new loan, you paid $200 in interest. So $2,500 minus the $200 means you netted $2,296 in savings. You might say, well, let's change this. Let's say it was a much higher rate. It's like a personal loan, no collateral, higher rate. Let's see what happens there. In this case, you would have paid on this new loan almost $390. You subtract that from the savings, and look, you're still better off by $2,119. All right, now let's add another one. That's a 12-month loan. Let's say that 12 months later, you do it again. So 14 plus 12, 26. You get another one. Bank says you paid it off. Great, we'll do it again. Still a high interest rate, 12 months. What happens when we get two of them back to back? Let's hit calculate. Look at that. You saved $3,000 and 12 months. You saved $3,000 and you only have 36 more months of payments. Now, these loans cost you $700 in interest, these two loans. But by making that extra payment, $3,800 in savings. The reason, because you still paid this loan back. So the reason you saved $3,800 in interest is because you were able to pay down your balance really fast in a $5,000 chunk. We talked about that earlier. You drop the principal really quickly. Let's just, for sake of argument, stick with one loan here. Okay, savings of 21. Now, if you scroll down, it says initial loan. This is talking about your car. The amount was $50,000, interest rate of 12%, term 60 months. We started with month 12. Your payment, just like all the other ones, was just over $1,000. And then on month 14, we said on month 14, we put a $5,000 in because we got this new loan. $5,000 goes in. The balance goes from $41,000 to $35,000. And now the interest being paid is much more substantial. And because of that, you're not going to go the full 60 months. You're only going to go to 54 months of making that payment of $1,000 a month. Now, here's the part that you have to realize. The downside of this is, it's still not a downside because you're saving money, but here's the second loan. This is the loan of $5,000, interest rate of 15% for 12 months. That's what we put here, $5,000, 12 months, interest rate of 15%. Your monthly payment's $449. So in order to do this, you're going to be paying $1,096 on this loan a month and $449 on this loan a month. Principal and interest, it goes for 12 months. Okay. So for these 12 months, you're going to be having to pay a larger amount, almost $1,449. You're still going to end up paying the same amount of money to pay off the principal. The principal was $53,500. You're still in this case. That's because we had tax. So assuming the same tax on all of these, this is doing $50,000, but essentially you're still going to pay off that balance. So if it's $50,000 is what you owe, even though you're making a larger payment these months, you're going to make less payments and you're still going to pay the same amount. You'll still pay the $50,000. You're just going to be paying it much faster. So in the one case you added, let's go through the options. You added, say, this very first one, $100 a month or $200 every single month. What does that do throughout the course of the loan? The second option was, well, what if I just got a chunk of money one time, sold some things and put it down? Of course, there's no loan terms with that. You're just making a lump sum payment. The third one is, well, I'm able to make a lump sum of $5,000. But it wasn't from selling things. I had to get another loan. And that loan has costs and that loan has payments. So in every case, you're paying the same amount for the principal. You're just paying it down. This particular way of a lump sum compared to the monthly amount, the lump sum will have a greater savings. Why? Because the monthly amount is a little bit every month, bringing the balance down a little more each month forever. This method with a new loan, takes a chunk, and when you drop it into the loan, you take your balance down much faster. Now the interest is calculated on this. So the sooner you can make a lump sum or a loan payment, the sooner in your schedule. If you only have a couple months left on your car loan, this isn't going to help you. But if you just started your car loan, the earlier you are, 6 months in, 12 months in, 18 months in, you're going to get a much better effect than if you were, say, already 50 months in on a 72-month loan. All right, so those are how the calculator works, multiple ways of helping bring it down. Now, that's if you're able to have a little extra money to put towards it. You can see the savings you get, and you might say to yourself, wow, if we put an extra $200 from this one calculator every month, we're going to save $3,000. That's substantial. That really is. Plus, it's going to knock 9 months off your loan. For me, I've got many videos on how to do planning, but look, if you have someone and they're about to go to college in a couple years and you want to get rid of this $1,000 monthly car payment and you're able to knock 9 months off, well, that might be right about when they're starting college. If you can get 48 months down to 39 and that $1,000 a month is gone. So now you've freed up some more money, plus you saved interest. Okay. Now, what do you do if you're in the situation where your car is, as I said, underwater? So you owe more than it's worth. So let's look at this initial calculator here. And we said 53.5 monthly payment. And we're going down here. And let's say you pay, you make your payments and I don't know, you're on month 13 here. You've paid your loan down to $44,454. You're tired of your $1,000 payment and you say, you know what? We got to make some changes here. Let's get a different car. I think we found one that maybe might have let's say a $500 or $600 payment. Let's do that. And let's get rid of this one with a $1,000 payment. You go to trade it in and they say, okay, what do you owe on the car? And you look and you owe now $44,454 because cars had shot up so much in value. You bought it a year and a half ago. Car prices were through the roof. Now, maybe that car is only worth, let's say, $38,000. So they'll say, we'll give you as a trade-in $38,000 for it, but you owe $44,000. So if we're going to take that car, we have to pay off your bank loan, but we're only giving you $38,000. So $44,000 minus $38,000, where's the other $6,000 going to come from? Well, they're not going to do it. They're going to say to you, all right, give us a check or give us cash of $6,000 so we can pay that off. The other scenario is sometimes, depending upon the dealership, usually if it's a new car dealership, maybe a used, they might be able to add it into the loan of the next car you're buying. Not saying it's always possible that some might say, okay, you're getting this other car for say $20,000. Maybe we can roll and give you a loan on that car for $26,000. Or maybe we can give you a loan for $22,000. You got to bring 4 more to the table. Not a good scenario to be in. There's multiple ways to get out of it. However, what I would suggest is if you think you need to get out of it, you say to yourself, you can look online, Kelley Blue Book and other places, and say, what do I think I will get as a trade-in value? You can even go to a dealership, new or used, and say, what would you give me as a trade-in? What amount of money? Then you look at it and you say, all right, I owe $44,000. They're telling me they're going to give me $38,000. I'm $6,000 off. Now, I don't have the $6,000, so what can I do? Well, then you look at these multiple ways, these calculators, and you say, well, what if I added extra money to my payment? So if you needed to get down to $36,000, you've already paid off 12 months, you want to get to $36,000 quicker. If you had the regular loan and you're making no additional payment, if you go down here, $36,000 is month 20. All right. Well, let's say you could put in another $300 a month for whatever reason. You pick up extra hours, you pick up more hours, whatever it may be. You hit calculate. Where's $36,000 now? It's right here, month 17. And what was it a second ago? I already forgot. It was month 20. So that would mean that from 12 to 17, that's 5. 12 to 20 is 8. So you could look to potentially trade it in 5 months instead of 12. Now the value over 5 months, it might go down a little more, but you get the idea. You can say to yourself, what do I need to do to try to get myself to an even trade-in? I might have to add every month, or maybe we sell something that we can give up, maybe an old watch we've got or a bike or whatever. We get a lump sum, and then what can that lump sum? Use a lump sum calculator. What if we added that in right now? What would that do for us? Where would that put the 36? And it would bring it up. Let's say if it's $0, 36 is here at month 20. 1,000 lump sum for selling something on month 12. Calculate. Now it's month 18, so you're bringing it up. So there you go. So if you are underwater on the car and you have to come up with a little more cash, or they're not able to, roll it into a new loan, or maybe not all of it, and you need to bring it down a little faster, use the calculators to say, what if I did a lump sum? What if I was able to add a little bit every month, bring that number down faster so that it fits and it's equal with the market value, so that they'll be able to pay off the car when you trade it in without you having to come to the table with money. I know I went through some of it sort of fast, but each one of these calculators has a detailed video you can watch on exactly how the calculators work. Put in your numbers on all of them and see how much you can save. And if you are underwater, know that there are many people that are behind on payments. And I'm sure because of the cost of new cars, there are many people that are finding themselves currently owing more than the car's worth. It's not uncommon. Don't get upset. Everything is just numbers, and there's always a way to help you get out of it faster if you're willing to look at the different options and then put together the different scenarios. Sit down either yourself or with a loved one, your spouse, whoever it may be, your partner, and say, what do we need to do so that we can get out of this? Which one of these are we going to pick? I really hope you can get out of debt. That's what my whole channel is about. If you haven't already, hit subscribe, hit like. I'd appreciate it. Have a great day. And I hope you're able to get out of debt and on to a better, brighter future, because I really believe that true freedom is financial freedom.